philosophical boundaries.
I gave a presentation in Florida once at a resort. It had a great golf course, the Blue Monster down at Doral. And when I finished, they said, well, it's time for questions. And the first person stood up and said, I don't actually have a question. I just want to thank you for ruining our day. So I'll leave it at that, but I think we do have some time for questions, Duncan.
Thank you, sir. I'm Tom Barnett with Institute for Defense Analyses. The other evening I caught something showed up on the TV there. It was Ben Bernanke talking to a reporter, and he was defending the QE2 effort by saying he wasn't printing money, he was merely swapping it with himself, or words to that effect. And I thought, huh? Could you explain the huh?
Sure. I hate to be didactic, but it depends on what you mean by money. What the chairman was referring to, there are different definitions of money. There's M0, which are bank reserves. There's M1, which is what happens when a bank takes the reserves and makes you a loan and credits your checking account and expands the money supply. And then there's M3, when you want to throw in different kinds of commercial paper, money market accounts. So is a money market account money? It's pretty liquid. You can usually get it out, except in October 2008 you couldn't. So what the chairman was saying is that he is increasing M0. That chart I showed you that's on its way to 3 trillion, he is increasing that. However, the M0 is a little bit sterile, meaning the banks are not taking those reserves and turning them into loans. Banks can take the reserves, turn them into loans at a rate of about 12 or 14 to 1. So his 3 trillion could turn into 40 trillion of new money. So what the chairman was saying is that the transmission mechanism has broken down. The transmission mechanism from M0 to M1 and ultimately to M3 is broken, so he feels comfortable that he's not creating money. My point is that M0 is money. As far as I'm concerned, that's money. If the chairman doesn't think it's money, that's fine. I do think it's money, but he is correct that the increase in M0 is not going anywhere. That's because velocity is declining. You're not getting that turnover. The problem is that dynamically unstable? Does there come a time when very quickly and very unexpectedly the M0 the transmission belt is not only turned on, but you floor the accelerator and the M0 turns into 15, 20 trillion dollars of M1 very quickly. And that is what happened in the 1970s. As late as 1968, 69, inflation was only 1 or 2%, and all of a sudden hit 3%. Everyone's like, wow, it went from 1% to 3%. That looks a little scary. 2 years later, it was 8. 2 years after that, it was 12, and then it went to 13. Between 1977 and 1981, 5-year cumulative inflation was 50%. Take your dollar, cut it in half, and that's what happened in those 5 years. People said oil quadrupled. Oil didn't quadruple. The dollar collapsed, and you needed more dollars for a barrel of oil. It was still a barrel of oil. So the chairman he was not lying. He was not being disingenuous, but he was relying on a very technical distinction between M0 and M1. I hope that answers the question. Welcome.
Justin Shirk. You mentioned earlier the Federal Reserve at one point might have negative equity. What's the practical impact of that?
I think it's mostly psychological and behavioral. If you can, actually, when I mentioned that, I put that in a blog post, and a lot of the comment I got back was, well, the Fed can't go broke, they can print money. I was like, no, you don't understand. Printing money is a liability. It's not capital of the Federal Reserve, it's a liability of the Federal Reserve. So you can expand your balance sheet. What would the practical impact of the Fed having zero capital be? In the strict technical sense, probably none. There's no reason why they couldn't carry on business and keep printing money. But I think that behaviorally, psychologically, socially, and politically, it would be highly significant. It's never happened, so that's just my analysis. But I think you can argue that both ways.
Hank Malinowski, Marine Corps. I'm just wondering your opinion on what Dr. Bernanke and the Treasury should have done during the 2008 meltdown. Just from what I know of Bernanke, he studied the effect of the Great Depression and probably the best guy alive to be in the job that he was. So I'm just interested in your thoughts.
I'll leave the second point aside in terms of what he could have done. The best guidance ever given for the art of central banking, and it isn't art as much as science, was from Walter Bagehot in the 19th century. He wrote a classic, he was a political scientist, lawyer, and philosopher. He wrote a classic book called Lombard Street, which was basically a case study of central banking focused on the Bank of England. And he said, in a crisis, the central banker should do three things. He should lend freely against good collateral at a punitive rate, meaning should a central bank make money available to the banking system and the banks in a financial panic? Absolutely yes. That's what they're there for. But show me your collateral. Basically, everyone knows that banks are not robust to run on the bank. They take short-term deposits and they make long-term loans. And we all know that if all the depositors show up on one day, no bank, however well managed, could pay off all the depositors in a single day because you can't liquidate your assets that quickly. So the role of the central bank is to say, when the depositors are lined up out the door, I take my assets over to the Fed, I get some money, and I pay off my depositors. So that's the role of the lender of last resort. But it presupposes two things, that I'm solvent and that I have some assets. And that's what Bagehot meant, because putting up good collateral was a way to separate the solvent from the insolvent institutions. In other words, you've got a liquidity crisis, right? But it could turn into a solvency crisis. And the way to sort out the winners and losers in a solvency crisis is by asking them to post collateral. The third thing is charge a punitive rate. It's like, a General Electric, you need $12 billion? Fine, no problem. I'll wire the money to your account, but I'm going to charge you 6%. It's not going to be free. And in the crisis, the Fed only followed one of those three rules. You know that Meatloaf song, 2 out of 3 ain't bad. The Fed got 1 out of 3. They lent freely, but not against good collateral and not at a punitive rate. So the moral hazard spread, there was no signal to the financial system that, if you come to us, here's the money, but we're kind of like loan sharks, it's going to cost you a lot. And it's interesting that under Dodd-Frank, the Fed was required to disclose who got the money. They were not required to disclose the collateral. The collateral is still secret. There are Freedom of Information Act requests pending on that. But it looks like Citibank in particular was allowed to pledge some like CC bonds at par, which is a gift. And so, the short answer to your question is, I would have, as a central banker, I would have lent to a lot of institutions. I would have lent enormous amounts of money. I would have created a lot of money. I would have been rigorous about the collateral. I would have charged high rates. By the way, that money goes to the taxpayers. See, when you charge, if you should charge 5%, you charge 0. That's a gift from the taxpayer to General Electric. If you charge 5%, it's money going from General Electric to the taxpayer. So the taxpayers were depleted in order to finance major institutions who were reckless. That's not something that I think goes down well in democracy, and very few people understand it, by the way. And there should have been more failure. JP Morgan would have come through fine. Maybe General Electric needs to come through with a little slap on the wrist or whatever. Citibank should have been nationalized. Goldman Sachs probably. The firms that actually were in line to fail, that were not solvent. Here's what you do. You take Citibank as an example. You nationalize it, but it's still open the next day, right? It's still operating. The lights are on. Everyone can go get their money. The ATMs work. You're not shutting it down, but you nationalize it. You say bondholders, you get 0. Stockholders, you get 0. U.S. taxpayers now own it. You go in and you lift out the bad assets and you put them in a black hole, right? Because the government has no cost of funds and no mark to market. So you put these bad assets over there. You hire people like me to work it out for you. I'm in that business. Then you take this clean bank and you IPO it exactly the way they did with General Motors the other day. You IPO it back, but it's a clean bank. Now it can lend. Now it can do business. Now it can grow the economy. You got rid of the rot. None of that was done. There was too much cronyism, too much of a desire to prop up the elites, prop up their friends, not let the chips fall where they will. Not completely, but to some extent to get this behind us. As a result, the system superficially looks better because these institutions are still standing, but the rot is still on the balance sheet and the economy is going nowhere.
I'm Mitzi Worth. I'm with the Naval Postgraduate School. I have sort of two crazy questions. One is, how does this relate to having jobs, the whole money game? And the other one is, have you seen Inside Jobs?
Haven't seen Inside Job. Tried to buy it on Amazon last night, but I guess it's not out yet. So I'll see that maybe before Christmas. I hear it's pretty good. I have
to tell you, I came away in such a set of rage. My view is all of them should be behind bars, looking at the consequence of what they've done to the entire global economy. And we sort of say, well, I mean, it's all these guys sort of taking care of each other and forgetting the rest of us.
Yeah, I agree with that. And I think one of the problems is that there aren't more people behind bars. I think there should be. But there's an interesting dynamic there, which is Ever since Drexel in 1990 and Arthur Andersen in 2000, the lesson is if you indict a financial firm, they fail. In other words, instead of innocent until proven guilty, you actually fail immediately because as a counterpart, as a depositor, as an investor, I want no part. I don't want my money at the scene of your train wreck. So when you indict a financial firm, they fail. But we know there's a set of institutions that are too big to fail. We know who they are. And so you're in this conundrum where maybe you broke the law and I want to indict you, but if I indict you, you fail. You're too big to fail, therefore I can't indict you. Therefore, you're beyond the law. It's like the Justice Department won't go after them because it means that the institutions that they just saved are going to collapse. So it's almost like you're above the law, which is, again, very contrary to a lot of our democratic principles. What was the first part? How do you create jobs? That's the easy one. Great companies like IBM, General Electric do not create jobs. They destroy jobs. They do it by mergers and acquisitions. They acquire smaller companies. They put that product on a global platform, generate revenues. You need about like $5 billion to move the needle at IBM. But you don't need 2 CEOs, 2 CFOs, 2 general counsels. So you destroy jobs, you increase your revenues. And that's fine. That's an okay business model. Jobs come from small business. They come from entrepreneurs. I hired a guy in California. I created one more job than the White House in the past year. So it's true. So that's where jobs come from. Now, what do you need to kind of get a businessman to step up and take risk? You need sound money, kind of low taxation, and light regulation. What are we getting? Debased money, higher taxation, and more regulation. So we've got the formula to suppress job growth. Therefore, unemployment should come as no surprise.
Can I just add on to that? What I'd like to know is what are the tasks, i.e. the jobs, that people could do in the United States, that someone in the United States would pay them to do?
Well,
I mean, I talk about small businesses, people who do nails or salons or restaurants.
well, there's nothing wrong with those jobs. Those are good jobs. But the answer to your question is that we don't know, and that's the point, right? 6 years ago, no one ever heard of an iPhone, right? That just came out of somebody's idea, Italian design, Chinese assembly, U.S. technology. That's precisely the point. You don't know where the jobs are coming from. What you do need to do is create an environment in which that kind of innovation can take place and then see what happens. But we've got I talk to CEOs and they just want to create jobs in this country. Well, the U.S. has a hostile business climate. By the way, this is not unique to Obama. This goes back to the Bush administration as well, that CEOs tell me the U.S. has a hostile business environment that they'd rather be in India. I mean, IBM is creating, they're hiring 10,000 people a month in India, and they're shutting down 10,000 jobs a month in the U.S. So their net employment's not changing much, but it's gone all towards India. Those jobs could be in the United States.
Len Bracken, BNA. Could you talk a little bit about the money market run in 2008 and how vulnerable are the money market funds these days?
It was a run. That's the best way to describe it. And basically, there was a large commercial, multi-trillion-dollar commercial paper market. A lot of corporations use the commercial paper market to fund their activities. Now, one of the things that's going on today that's kind of interesting is that corporate balance sheets have the most cash in history. They have several $1 trillion of cash. And a lot of stock analysts say, that's great, look at all that money on the sideline. They'll be doing M&A, they'll be expanding, they'll be buying their stock back and all that great. And the answer is no. That is not a sign of strength. That's a sign of fear. You don't have that much cash unless you're worried about something. And what they're worried about is that the commercial paper market will shut down and they'll have to fund their operations for 6 or 8 months on their own dime that they're not going to bail out the commercial paper market again. So the reason corporations have all that cash is that it's not a source of strength. It's a source of weakness because they're worried that they're going to have to finance internally without the help of the banking system. So that's a real problem there. But it goes back to this gentleman's question, which is, I'm obviously being very critical of Bernanke, and there's the counterfactual. Well, what would you have done? Would you have let unemployment go to 20%? Well, I would have had a lot more failure than we had to clear out some of the rot. But there are some places where you have to draw the line. Money market funds are one of them because American people treat money market funds the way they used to treat FDIC insured deposits. They assume that a dollar is a dollar is a dollar. And if you let those go down, then you really have nothing left. So I'm not averse to kind of bailing out the money market.